What's going on, everyone, and welcome back to another episode of Crypto Over Redbull, the podcast where caffeine meets crypto. I'm your host, DeFi Sean, and today we're diving into one of the most talked about and misunderstood assets in the Web3 space, utility tokens. You've heard the term thrown around in white papers, Telegram chats, and Twitter threads, but what exactly is a utility token? And more importantly, how do you navigate them safely, whether you're building or investing? So go ahead, pop open that Red Bull, and let's go. Since we're talking about utility tokens, today's episode is sponsored by Infinion, the infinitely smarter blockchain and the ultimate utility token. Pretty much all of your green flags are checked, as we're going to talk about in this episode, to having utility prior to launch and continuing to build with the blockchain live, the DEX live, Lunar Pump Fund, the ultimate token launcher live, the wallet in beta and about to go live on Android, and so much more in the pipeline. They just continue to deliver. So all of the links that you need for Infinion will be in the description down below. So starting with the obvious, what is a utility token? Now, a utility token is a type of digital assets that gives users access to a product or service within a blockchain-based ecosystem. Unlike security tokens, which are more like traditional investments and often tied to equity or revenue sharing, utility tokens are meant to have functional use. Think of it like a digital ticket or access point. So for some examples, you have BNB, originally used for trading fee discounts on Binance. You have ETH, which is not just a currency, it powers transactions in smart contracts on the Ethereum blockchain. And you have Matic, used to pay for gas fees and access services within the Polygon ecosystem. Utility tokens can fuel everything from transaction fees, governance and voting rights, staking for network validations, access to premium features, in-game assets or rewards, and even launch pads and decentralized exchanges. Now, why are utility tokens so popular? Early adopters can earn and use tokens within the ecosystem. Instead of raising VC money, projects can use tokens to drive growth, and communities have more say in how platforms evolve. When done right, utility tokens align users with growth of the ecosystem. The more value the platform delivers, the more useful and potentially valuable the token becomes. Now let's go over the do's and the don'ts if you're creating a utility tokens. So do build the product first. Don't launch a token if your ecosystem is just an idea. A utility token without utility is just a token. Focus on launching the app, DEX, or service first. Let the token support it. Do ensure real utility. Gas fees, discounts, staking rewards, governance, whatever it is, the token should do something. Make the token indispensable to your ecosystem. Do be transparent about tokenomics. Break down supply, emissions, vestings, and burns clearly. Community trust is built on clarity, especially when liquidity and inflation are at stake. Do comply with regulations. In many jurisdictions, even utility tokens can be scrutinized under security law. Work with legal teams to stay compliant, especially if you're in the United States. And lastly, do align with incentives. Your token should reward users who help the ecosystem grow, not just early whales who dump after launch. Now for the don'ts and the common mistakes to avoid. Don't launch before product market fit. Launching a token without users or traction turns into pure speculation. That's how ecosystems die fast. Don't overinflate supply. 1 trillion tokens might look flashy, but it usually signals poor tokenomics. If your token has no scarcity or burn mechanism, value gets diluted. Don't fake utility just for hype. Just because a token could be used for governance or staking doesn't mean it should. Utility needs to be meaningful and necessary. Don't ignore community. Utility tokens live and die by their communities. If your holders feel left out or misled, they'll exit faster than a Discord rug pull. Don't make promises that sound like securities. Avoid phrases like guaranteed returns or passive income unless you want to tango with the SEC. Utility tokens should not be marketed like investments. Now from an investor standpoint, if you're buying a utility tokens, here's how to stay smart. Check the product. Is it live, functional, growing? Study the tokenomics. Scarcity, burn mechanisms, investing schedules matter. Review the roadmap. Is the team building or just tweeting? Look for community health, active devs, real users, organic conversations. Avoid hype-only tokens. If the token exists purely to pump, you're holding a bag, not a utility. Now, probably the most important section we're covering from an investor standpoint on this episode is red flags. Before you put your money into any token that claims to offer utility, hit pause and do a check. Here are the biggest red flags that should make you think twice or even run. No working product. If the token is live, but the product is quote unquote coming soon, that's a huge warning sign. You're not buying utility, you're buying a placeholder for promises. Real projects deliver first and hype second. Anonymous or unverified teams. A team without LinkedIn profiles, developer history, or verifiable credentials is a gamble. While anonymity has its place in crypto, you deserve to know who's handling the treasury, or at least verify that there's real accountability. Vague or overhyped white paper. If the white paper sounds more like a motivational poster than a roadmap, that's a big problem. Look for concrete use cases, timelines, tokenomics, and development details. Fluff is not a foundation. Massive, pre-mined, or unfair token allocations. If 60% of the supply is held by insiders, early investors or the dev team expect a dump. Healthy tokenomics should prioritize the ecosystem, not enrich the founders. No burn mechanism or inflation control. Unlimited supply or unclear issuance schedules means the token could lose value fast. Look for sustainable mechanisms that protect long-term holders like burns, caps, or emission schedules. Obsession with price instead of product. If all the updates are about price or pumps and listings, but never about features or users, that's a speculation-driven project, not a utility-focused one. Paywalls to basic features. If you need the token just to use basic parts of the platform, it might be a forced sync. Utility should enhance the experience, not gatekeep it. And lastly, dead community or fake engagement. Check the Telegram, Discord, and Twitter. Are there real discussions or just bots and mods posting when meaning? A silent or botted community usually means there's no real user base. Now, these red flags won't catch every bad project, but they will help you separate the real builders from the cash grabs. Also, do your own research and trust your instincts. If it feels off, it probably is. To close it out, utility tokens are one of crypto's most powerful tools, but also one of its biggest traps when misused. When done right, they create thriving, decentralized ecosystems. When done wrong, they become just another bag on someone's exit pump. If you're launching one, do it with purpose. If you're investing, do it with caution. That's all for today on Crypto Over Redbull. If you've got questions or want to keep the conversation going, hit me up at cryptooverredbull@gmail.com or hit me up on Twitter at Krypton or check out my YouTube channel, Krypton Investing. As always, stay caffeinated, stay curious, and trade safe.